Well, welcome, Jamie, and thank you for coming back to the GSB.
I'm thrilled to be back to the second best business school
Okay.
in America.
Well, it's an honor to be here with you. You've been here from View from the Top many times. You may have set the record, I think. So it's great to have this opportunity to have you back as part of our Business, Government, and Society initiative, which really gives us a chance to talk a bit more in depth about changes and challenges in the banking industry, the role of government oversight and regulation, the risk and opportunities you see ahead for the economy and sort of the geopolitical framework as a whole. So here we are, we're 38 days in to a new administration. Much of what we're hearing about is cutbacks on government oversight and regulation. But I wanted to start by sort of rewinding a bit to a time 2 years ago when it was really important to have the government step in, and that was the banking crisis that we saw in March of 2023. At the time, the Fed had raised short-term interest rates from 0 to 5%, trying to slam the brakes on surging inflation, and things started to break. Silicon Valley Bank, with $200 billion in assets, collapsed. It was quite a scene here in Town Square at the GSB, with students rushing to try and move their money from their startups to other banks in the moment. Soon after that, First Republic fails. Can you tell us why? What happened and caused these seemingly very successful banks to fail in that environment?
First of all, I am thrilled to be here, and I'll try to answer everything as honestly as I can. Rates were going up. Rates going up is always a danger sign, okay, for a lot of people. Remember, they went from 0 to 2 and then from 2 to 5. The 10-year went from basically 2 to 5. It shouldn't have been a surprise. I wasn't surprised. The Fed was surprised. They were telling you all that it was going to stay at 2%. And they were telling all the banks that. They were telling the world that rates were kind of going to be low forever. And when they started going up, kind of Warren Buffett's quotes, when the tide goes out, you see who's swimming naked. And so you saw it in a bunch of things. It wasn't catastrophic. The only catastrophic was those two banks and another one called Signature. And they had, Silicon Valley Bank and First Republic had two things. One was known and one wasn't really known. One was this kind of, we talk about uninsured deposits, but this is more like uninsured deposits that were kind of like a flock, very concentrated. So it belonged to all the venture capital companies. So it was the 1,000 venture capital companies and their 30,000 constituent companies. So when the venture capital guys sent that email out, move your money, all these people moved. And also all the people that worked those companies. And so you literally had a Silicon Valley Bank, $100 billion moving a day. That was unique, hadn't happened before. It's not the same as uninsured deposits, which is what some people think. And First Republic had essentially the same thing. I should point out, and the second thing which was known to everybody, any one of you who can read a balance sheet, is the interest rate exposure that Silicon Valley Bank had. They'd invested a lot of their money in 3% mortgages, in HTM, held to maturity. The difference in held to maturity and affordable for sale is in held to maturity, you don't have to market to market. But the world, I always tell people, forget the accounting. The market decides whether they think you're good or not. And what happened is their big portfolios lost a lot of value. And then when you said, what's the tangible book value of Silicon Valley Bank? If they had to market that to market, they had lost, I forgot, 75 or 80%. And that kind of caused the run. This huge loss of that, people run out. They hadn't pre-positioned collateral at the Fed, so they were unable to sell some of these bonds they had. They had a liquidity crisis. Government steps in. They stepped in very badly. They made a huge blunder, which I won't bore you with, which cost all of us $10 billion. Us, by the way, is the banks. FDIC is a mutual insurance company that the banks pay for. The government has never paid a penny. It's cost us $20 billion in the last 10 years alone. Okay, so this kind of moral hazard of mismanagement by the FDIC. And then First Republic in the same position. They let it go on for too long. We called up, Secretary Yellen and whoever and said, we can handle it. And we went back and forth, and we ended up buying that. We didn't have to do it. We didn't necessarily do it. We did it to help the system. Obviously, it had some financial benefit for us, and you're going to see some new branches around here as we try to replicate some of the things that they actually did do very well. And of course, the second we bought it, you never heard about it again. We just sucked it in, managed it, hedged everything overnight. But it did take 10,000 people working a year to do it. And when you say the government bailing out, the government had no idea how to do stuff like that. JPMorgan bailed them out. The other banks paid $10 billion to do it. And so that's what happened, and it does highlight people then come up with all the reasons they should change rules and regulations. If I had been running the FDIC, I never would have allowed interest rate exposure like that, ever. Sine qua non. The other stuff they might have missed, and there are other things you can be fixed about the discount window and how you have to pre-position collateral and some technical stuff. Had nothing to do with capital per se or so. And it shouldn't happen. I mean, two little banks basically go bankrupt. It's a whole big kerfuffle. We should have built a system that's more resilient than that, and it's not. So all this resolution recovery stuff, and basically, as I tell them, it doesn't work. So we should go back to the drawing board and build a system. If the bank fails, it's not a big deal. And there are ways to do it. Some technical, some may take legislation that you have a banking system which is, doesn't have a problem that causes it for everybody.
Let's talk a little bit more about that and what could give more resilience in the banking system. At the time, you mentioned sort of two key banks failed, but research by some of my colleagues here at the GSB suggested that there were hundreds of banks that were potentially in a similar position to Silicon Valley Bank and others in the sense of not managing their interest rate risk effectively, which calls some question into the regulations involved. But going back to that, first of all, if the Fed had not stepped in to insure depositors and lend against the collateral they had,
the FDIC,
exactly. Do you think the problem has gone away? Have we recovered from that, or is it sort of covered up and festering?
When we bought First Republic, we were quite public. We said, this is the last domino unless rates go up. And so we do what I don't know your academics did here. We have a heat map, and we do bank by bank, name by name, what would happen if rates go to, I'm going to say 6%? What would happen to the value of their real estate portfolios? What would happen if there was a recession? What would happen to their HTM? And so if that happened, a lot of banks would be in the red zone. So they were close to it, but not in it. Rates did not go up more than that, so they were kind of fine. But I still say if rates go up, and you have a recession, some will be in the red less. Some have been more responsible by raising capital, raising liquidity, being a little more careful, putting up reserves for commercial real estate. But if rates go to 6%, hey, folks, a lot of stuff is in the red zone. And there's most people don't believe it's possible. It is possible. I'm prepared for 8%. JPMorgan do fine at 8%. We don't run our company betting on interest rates, and so. But that if you had higher rates and higher credit spreads, certain private equity, certain private credit, there may be some insurance companies, there might be a bunch of banks, there are probably some things we don't even know about today that kind of comes out of the woodwork at that time. So that's what could cause a thing, which is think of stagflation, recession, which most people don't even put it on their radar scope. And another very important point, the Fed's the CCAR test that people do is one test. And it's basically a great financial crisis test. It's a full of shit test. It doesn't work. It doesn't make a damn bit of difference. We do 100 a week. If you think I care about their one test, but it lulls people to a false sense of security. And so the regulators are spending all the time on this other stuff as opposed to maybe what they should have. So what I look at, which I think people should always do is, and I think it's a good intellectual exercise, particularly for students, lay out all the possibilities, whether you believe they're true or not. Can we have a recession with 0% rates again, a boom market with 0% rates, a recession with 8% rates, stagflation? Can we have markets that actually go? Yeah, you can. And also think what would cause that? Because it makes you think a little bit harder about what are the factors, the future factors out there, not the past factors, which people focus on, but the future factors that could really affect this stuff. And that's called basic risk management. Mm-hmm. There are a lot of different what ifs, and how can you handle it? And basically, when you're a business, you want to be able to handle that regardless. So if we had 8% rates with the stagflation, JPMorgan would be fine. Our earnings would be down. I don't actually care about that much, but I can invest in the future. We can hire people. We can serve our clients. We don't have to pull back anywhere. So that is what I think they should be doing, and that's why I've always thought the CCAR thing was literally a complete misguided effort at risk management.
The key lesson, again, risk management and sensitivity analysis, something we talk a lot about here. I want to go back to sort of improving resilience. You mentioned that there are changes that could be made that could increase resilience. If you have $100 billion in assets and $90 billion in short-term debt, it doesn't take much to go wrong to put a bank in trouble. Do you think there would be some advantages in terms of reducing increasing systemic resilience and reducing risk in the banking sector from increasing long-term equity capital?
Not really. The capital is not the issue. I know that you have some professor who think, 25%. We have $300 billion of equity capital and $1.2 trillion of loans. It is 25% of loans. We make $60 billion a year. Even the stress test has us losing money. We make money that year. It's not capital. There are other things which are, cause problems. And there should be nothing wrong with banks going bankrupt. That's the normal system. They're trying different things. They're doing different things. They're merging different things. So you're not looking for fail-safe. You're looking for a system that's healthy construction, deconstruction, or stuff like that. And so our system, I have a thing I put in my chairman's letter years ago called the spaghetti chart. We set up, not all Dodd-Frank was wrong. So I'm not arguing that. I'm not arguing that all regulation is wrong. But you got to take a step back at this point, a Byzantine system. We set up multiple regulators. There are 7 responsible for mortgages, 5 responsible for exchanges, 3 responsible for this. They can't even agree among each other what to do. So it literally cripples them. And then I look at this GSIFI, which probably you don't know about. The calculation is completely asinine. CCAR doesn't work. Basel III was ill-constructed. And cutting across all that, resolution recovery is 80,000 pages long. It will never work. It's a complete waste of time. And so you have this system now, and what have they been doing for 10 years? Just adding more. Liquidity, LCR, GSIFI, TLAC, this thing. So some of those things are good, but you should also ask yourself, what they missed was the opportunity to take a step back and say, how do you build the best financial? We have the best in the world, so just keep that in mind.
Well, on that point,
but they should have stepped back and said, what do we want? What do we want in the system? What do we want out of the system? How much resilience do we want? Do we want bankruptcies? Do we want more insurance? Do we want to favor small businesses? They never did any of it, ever. Nothing. No cost-benefit study, no analysis, no expected outcomes, zero.
Well, on that, you talked a lot about the micromanagement and the level of regulation on many activities. Going back to the previous point, if we had sort of more skin in the game, more equity capital, and as a result could back off on many of that micromanagement of the asset positions and things like that the bank is having, is that a good trade-off in your mind?
No, because the equity capital isn't going to fix any problem. And then you're creating huge arbitrage opportunities, which, look, if the regulator said, we want lending outside the system, so be it. Say it. I'm fine with it. We'll deal with it. We'll figure it out. But they don't. So if I have to hold, 2 times more capital than private credit, which is what it is today, then it belongs over here. And and in some cases, by the way, it's 5 times more because of insurance accounting rules on how they look at credit. Now, of course, is that going to last a crisis? And this is the other thing about the future. Will these insurance accounting rules that are arbitraging credit in the marketplace going to last when the shit hits the fan? They won't. And then you have another crisis, a major insurance company go bankrupt, something like that. So yes, if you wanted to drive it out, go ahead. But again, if you look at these things, it was more about liquidity than it was about capital. And you also have to ask, what do you want the financial system to do? Banks are kind of, think of it as flexible capital. A lot of these other investors are not. The banks are flexible, and we're there in thick or thin, financing our clients, regardless of the environment. These people won't make a loan if things are bad. And you really have to be very careful when you design a system. What is it you actually want? And so hopefully we'll engage in some of those conversations sometime soon.
Well, you talked about private credit. Let me push on that a little bit. So, we've seen big growth there. We've seen sort of the Apollos, the Blackstones getting into private credit. We've seen the business development companies serving the mid-market. 2 things. One is when you look at those institutions, they are much more equity funded, so have more long-term capital backing them. So in some sense, we don't see that arbitrage, I think, that you were talking about, right?
No,
they have much more equity-based funding.
No, they don't. Some do and some don't. So the insurance companies don't. A private credit fund does. They might be leveraged, 2 to 1 or something like that. But what you guys don't see is there are multiple layers of leverage in there too. They borrow against those loans. They have subscription lines over here. They pre-fund some of these other investments. Literally, you don't all see all that stuff that takes place. But yeah, in some cases they're safer. Like an insurance company, in fact, does have, if you're an annuity company, you may have longer dated liabilities and you have better liability matching than a bank might have. But you have to ask, and that's fine. So some are, and they're quite good at what they do, so I'm not criticizing that. But is that what you wanted? 80% of the mortgage business outside. And I'll tell you another consequence, which I'd love you guys to study. Who looks at public capital markets here? Is there a professor who does public capital markets? We've gone from 8,000 public companies in the early 90s to 4,000 today. The 8,000 should have gone to 16,000. Okay, private equity's gone from 1,000 to 10,000. And I'm not, again, this is not a statement about against private equity. The question is that a good thing? Is a public market transparency good? Is having mark-to-market capital good? And why did people leave? And if you analyze why people left, it was litigation, regulation, the compensation schemes. Boards have to cross T's and dot I's. It's the SEC. It's frivolous shareholder meetings. It's NGOs trying to get your company to do all these various things. People leave. I would leave the public markets if I could. But is that what you want? I think it's a bad idea for America. And so I think people should answer those questions before they say, I'm just going to impose more things on them. Because remember, the public markets are very transparent, and we have the best financial system in the world, including private credit and private equity. But I would go back to the thing, if you're going to regulate certain things, regulate the product the same. I would be more in that mode, and including inside insurance companies. So you have the market competing, but it's not arbitrage.
It's a great question you raise around the size of private equity and private debt and sort of the growth in that industry, and a good question to come back to. I want to turn to another set of regulations about consumer protection. We had Rohit Chopra here last week. He's former head of the Consumer Financial Protection Bureau. I guess it's fair to say you aren't exactly buddies. But can you talk a little bit about, do we need a regulator who's watching out for, those consumers who are less financially sophisticated to prevent, charging excessive or hidden fees to consumers and so forth?
Yeah, of course.
You on that?
Of course you need proper consumer protection. And again, it goes back to how you design it. And then someone made a statement recently, well, if they don't have it there, the banks would have consumer. We have consumer protection in the OCC. We have consumer protection in the Fed. When they did the CFPB, it was supposed to go to one place. It stayed in all three. We also get it effectively from the SEC. We get it from a whole bunch of other people, sometimes from the DOJ. Of course you want proper consumer protection. And I have no problem with Rohit. I think he's very smart. I think he's arrogant. I think that he's one of those guys, I told him, it was a major intellectual flaw, is when you use your brain to justify what you already think. And that's what he does. He came with a mission, and some of the stuff he knew wasn't exactly right, but it was kind of like, no, that'll show them, when he didn't mind unlike some other people, didn't mind being sued. Not everything he did was bad. I'm not against it, but there should be very thoughtful stuff about what is you're trying to accomplish again, and so some of his stuff was misguided, but I actually respected him for his intellect.
You talked about, the fact that we do have protections that are mandated through OCC and other places. But is there sort of a tension between, say, the OCC, which on the one hand has to look out for safe and soundness of the banking system, and therefore may be worried a lot about banks' profitability and so forth, versus having a separate agency that will think more specifically about sort of consumer products and what might be misleading for consumers?
So the consumers are being screwed all over the place, okay? Mm-hmm. But it's not from the banks, generally. And I just, there's payday lenders, there are cash pawn shops, there are all these various things. The banks, the fees are up front and stuff like that. And you have to ask yourself, yes, if you had the CFPB, you're going to have a piece that does banks. I would leave it in the OCC, because I think the better way to regulate someone is that you're regulating the whole bank. And so if you think our OCC spent the last 10 years on safety and soundness, they did not. They spent the last 10 years on consumer, politics, NGO, virtue signaling. So you're dead wrong right from the start when you say that the OCC should have been safety and soundness. If you look at what they do with these banks, they do CRA, that's consumer, we are the biggest affordable housing lender in the world, the most bank-on accounts in the world, but obviously you need proper consumer protection. But then when you set up a system, a payment system, and you talk about like overdraft or something like that, make it fair, make it reasonable, it's optional, you don't have to do it, Why are you doing something like that? So when he wants to set up a system that you can't do it at all, that'll push more people into payday lending. That's all. That'll be the outcome. So it may sound good, that would be the outcome. When they changed the Durbin stuff, I'm not opposed to some of it, 5 million people got unbanked. That was the outcome. And our government does this without regard to outcomes. They do it because it's ideology. And the real world isn't that way. And people should really analyze these things, say, what do we want? How do we want it? How can we incent good behavior? How can we get rid of bad behavior? And so you got to be a little, and there's a lot of taking place now, a lot of what I call a liability shift. The banks have to pay for this, and the banks have to pay for this. Like a third of I think 50% of the scams that we have go through social media. Scams, not fraud. This is where the person thinks they're paying a friend or something like that. And we beg social media to stop. They have no idea who these people are. They do nothing about it. And they say it's the bank's problem. And that's not the way society should run. And so the regulators, if you had a regulator that was in the OCC and consumer protection, they might take a little more of an interest about the other side and get involved in that. That you got to stop people from using social media to try to scam people, older people, elder people. But if you look at who's at the forefront of protecting people, JPMorgan Chase. It's not, and that's the other thing. They're constantly beating up these people who do more for elder care, more for fraud, the scam rate on some of these other non-bank payment systems is 4 or 5 times ours. You don't hear that, do you? You probably didn't hear that, Fro. He knows it. He sees the actual numbers. He doesn't report it to, and that's why I'm saying you got to be very thoughtful about how you go about some of these rules and regulations.
Well, your point that some rules can have second-order effects that don't work in the right direction is a good one, and certainly one to think about as new policies get constructed. But let me take you back to something very basic. If I look at if I open a savings account at JPMorgan today as a depositor, I see rates of less than 1%. If I were a big customer of JPMorgan, I could easily get market rates of over 4%. Yeah, well, is that something we should worry about and think about, and why that inefficiency?
That's a legitimate thing, and there are savings accounts and checking accounts, and those are closely related. But almost anyone can go buy a CD or put money in a money market fund. Almost anyone. And then when we have a banking account, you have, and this is the other thing about how services get paid for. It costs, I'm gonna round off, $300 to give you a banking account. Inside that banking account, you get a lot of free services. Okay, you get Zelle, you get payments, you get ATMs, you get branches, you get free checking, free this, you get debit cards, debit card replacement, you can buy and sell stocks for free, you get a lot of services. And the question for that kind of account is, how does the business make money? So when you go to certain things, you actually pay by the drink. You pay for the burger, you pay for the drink, and you do other things, you pay a number, or you pay here even though the costs are there. And so part of the way the banks make the money is on deposits. Think of it, they make about 2% of deposits. And that covers the, part of that $300 of the account. So we're always adding services. And yes, I always worry about when, you're leaving money idle that you shouldn't have left there. And we may have a better product for that one day. But most people have the option. They're not stupid. They have the option. A lot of people leave money there because they use it quickly or something like that. And we also have sweep accounts you can get.
Does it create an opportunity for new entrants? I'm thinking about, I know last year you said in a conference call with analysts that JPMorgan should be scared about payment fintech competitors, PayPal, Square, Stripe, things like that. We have a new Congress and administration that's probably more favorable to legislation that could unleash, stablecoin competition for payments or for services and things like that. Are you worried about that, or what do you think's coming?
So, we study everything, so am I worried? No. First of all, we do have competitors who did a very good job. That's a fact. And every time you have too much of a margin, you open up the thing that someone's going to do something better. That's good. I like that. I like to give you a choice, and I have to compete. If I got to figure it out, I got to bob and weave or stuff like that. But remember, a lot of the other people, so you can go, I don't want to mention them all by name, but some of our clients, they don't do a tenth of what we do in terms of protecting you, giving you access to ATMs, access to cash, access to security, free trading, free movement, checking accounts, debit accounts, all for free, fundamentally. And sometimes you have to pay a monthly fee, and maybe we should change how we pay for that. Stable coins don't worry me. Again, a stable coin, blockchain stable coin, we have a JPMorgan coin. Okay, it's a deposit. And you can move around just like that, 24/7, and so I'm not against stable coins, but they're basically mutual funds. Mm-hmm. Who's going to ascertain there are the assets there? So Tether is the biggest one. They say they don't really disclose a lot, but they say have T-bills and stuff like that. They also have Bitcoin loans. They also have receivables. They also have loans that they made to other companies. And so one day they might be running the Tether Bank. And the government, someone's going to say, they should have been regulated like a mutual fund. They should have gates and requirements and maturity requirements and all that. And that'll happen one day. So stablecoins probably are fine. There are problems that could be solved by a stablecoin. Okay, think of cross-border remittances. Now, central banks are not going to run call centers. So they're not really going to get into retail business, but they can move money. They can do it, or we can do it. Or like I said, we have but the JPMorgan coin, which is 24, already does all that. So in my view, is let's compete, and there will be stable. They'll have stablecoin legislation, and whether we do it or not, we'll see at that point in time. But I'm not actually worried about it.
Do you think the U.S. payment system currently, as it stands today, is as efficient as it should be?
The banking system.
The payment system within the U.S.
Yeah, it's pretty. I mean, when you say that, you got to be diligent about the credit card, debit card, checking account, safety in the system, KYC, BSA, Guardian. Yeah, it's pretty damn efficient because you all don't even think about it when you use it. Could it be now cross-border? Inefficient. Certain types of wires cross-border, so even consumer, but it's not remittances that someone's sending it to their family in the Philippines or India, but you're sending it 25,000. Very inefficient. Some of the Fed wire systems are slow and inefficient. A lot of those are going to be fixed by real-time payments, which we already have. And believe it or not, the take-up isn't very high because people like what they're doing. They're not really complaining about what they're doing. So a lot of protection in that. But yes, you can always be more efficient. And I always give if you were JPMorgan, I always give a little talk about Sears, Kmart, and Kodak, Digital Equipment, all these companies who didn't focus on getting better, faster, quicker, all the time, using technology, looking at customer complaints, knowing that there are people there. You should be doing that nonstop in any business you're in. And I know the Stripe, I know the Collisons quite well, and we do quite a bit with them actually. And so, yeah, everything can be made more efficient.
Well, not surprisingly, here at Stanford, AI is on top of mind. Do you see important innovations from your use of big data, machine learning, AI in the consumer-facing aspects of JPMorgan?
I see it in I think it is as real as the internet, electricity, the steam engine, the tractor. Yeah, it's big. Now, all those technologies, and you have to look at rollout at a pace different than you think, in a way different than you think, and they have consequences different than you think. And so we've been doing AI since 2012. We have 200 people in a research department, NLP, general intelligence. We have 2,000 people doing it. We have someone who reports to me and the president who does AI and machine learning, AI, all that, plus data. We mimic that in the credit card, trading, consumer, branches, all of that. In the operating centers, it's everywhere. So we have 450 use cases. We spend $2 billion. We probably save or make about $2 billion. The 450 use cases will go, my guess will be 800 by the end of this year. And they're very specific, risk, fraud, marketing, movement of money, scams, elder fraud. It hedges our equity portfolios today. It's used by traders. It's used by trading machines, I should say. There is nothing it's not going to touch. So in call centers, it's already been used to anticipate why someone's calling in, and then to give the call center person the proper information, their fingertips to answer the question. It's going to be agentic soon, where it just sends you the debit card you lost, or it just makes decisions on behalf of the company. It already takes care of errors. The way I look at it is that big. Just do it. Don't spend that much time debating it. I don't need to hear open, closed, big, deep seek. It makes no difference. We're going to deploy the tool as it's going to change over time. The cost may be more than we thought. They may be less than we thought. Again, I'm not going to worry about it. We're just going to be the best at it. And I do think bad guys are going to use it. We know that. They're already using it on us, and mostly related to cyber, and cyber is already bad. So yeah, you have to do it. And it should be regulated properly. I hope it isn't over-regulated. It will affect every single job out there. Don't put your head in the sand. There are a lot of companies who don't want to talk about it openly because we're scaring people about jobs. It is going to replace jobs. So did the tractor and fertilizer. So if you want to create 40 million jobs, I can do that with 2 pieces of legislation. You can no longer use tractors in farms, and you can no longer use fertilizer. You're going to need 40 million people working 6 days a week, 12 hours a day, making $6 an hour. You create a lot of great jobs. So, jobs, not great jobs. So, but my view is, whatever it does, we have great humanity. So we have 100,000 people in ops. So if it affects that, and you say it's going to eliminate half those jobs in the next 5 years, well, attrition is 15%. The more I know about it, the better. The more I can plan for it, then let attrition be my friend, and where necessary, redeploy, retrain, et cetera. And so, yeah, I'm not afraid of it. We're going to use it, and there's not one job that won't be touched by it. Some just as enhancing your job. Some were doing agentic stuff. Some where it may eliminate a job or two, but.
Well, JPMorgan, because of your size and the data you get to see, obviously you have a big advantage in terms of using these and using machine learning and other types of tools. What's your view about regulations like open banking, which are being adopted by many countries that would allow competition to have consumers to allow competitors to have access to their data to
You're already showing your bias in this one. First of all, I should have said this. We have 200,000 people using LLMs on our own data.
Yeah.
So if you ask how many companies can be downgraded, such and such in Argentina, it'll tell you. Mm-hmm. It'll just read 100,000 documents in a second, and 100,000 people use it every single week, and so it is unbelievable. And now we have huge data. So, and a lot of the world's data is private. It's not in the internet. So you got to keep that in mind. So we can run machine learning and AI against both our data and outside data. By law, we can't give away our data. Mm-hmm. So you can study it. We allow it, like academics come in and study it with anonymously to see cause and effect about a whole bunch of different things. But we can do both. And of course, some of these things are just storing how you use it and how you. And I only want to use it to help my customer. I will not use it like social media. I want to give you menus, let you pick. Let you tell me if you want ads, you want to see them about Scotland, you want to see about travel, you want to see about golf, as opposed to we just swarm you with stuff that is what you want. So we're going to use that data to offer what you want. Open banking, we have never been against open banking. I believe you own your data. And if you tell us to give your data to someone, I'm totally fine with that. What these guys want is access to your data. Okay, and all of it. So I want to give you the choice, say, I want to give them this data, but not that data. I want this, but not that. I want it to last for 6 weeks. But, for example, some of these companies took your data, you signed up for, how many of you took Plaid? Raise your hands, be honest. How many of you do any of these outside parties that take money from your bank account? Just raise your hands. In a lot of those cases, you signed up years ago, they're still taking your data. They're taking all of your data, all of it, and they're selling it. Okay, I wouldn't do that to you. So we've got the high road in that. No, I'm being serious. I just don't like it. So we actually closed some of these guys down and said you can't do it. I want you to use your data, and you can move It's very easy to move your bank account by just write a check. But I want you to use it the way you want it. And the other thing is liability shift. They want to take your data. And if you make a payment that has a scam or something through some of these other things, they want you to look at JPMorgan when they gave the data to someone else and you were scammed. So we are okay. If you were scammed on that platform, they have to pay. You can't have a bank pay for your mismanagement of data. So just all these things be very analytical, be very clear, be very fair, be very consumer friendly, and I would be in favor of it. But a lot of them, that's not what they want.
Let's broaden a little bit to the political perspective, come back to that. President Trump has spoken repeatedly about his desire for lower prices and lower interest rates. Unfortunately, these are not things you can do by executive order. Do you think things are on the right track to achieve that, or what are you concerned about?
I think he's right to be very pro-growth, and because growth is not good growth is not inflationary, it's good for the people, it's good for all different income classes. And I think he's right to be for deregulations, not getting rid of regulations. Think of a lot of these a bureaucracy like you've never seen before, and you guys see it a little bit. You probably see it when you fill out your forms for Stanford, or something like that. It's unbelievable, and we've crippled our nation with it. And I mean through multiple things, and we should recognize that. Everyone wants low inflation. I mean, name a president ever who said, "Give me higher interest rates." It doesn't happen. So, and he can't control it. Yeah. He can jawbone, but he can't control it. He may get, the Fed to lower short-term rates, but he can't control 10-year rates. That's actually controlled by the world, the buyers and sellers of the world. And he could try to jawbone that. It will not work. That will actually, traders may move around to that, but that will actually be based upon supply and demand of U.S. dollars, which includes long-term duration, foreign buyers, internal buyers, investment buyers, inflation expectations, the whole shebang. And tariffs themselves, depends how you use it. If they're small, they're modest, they're used as a tool or kind of a weapon to do, in some cases, good stuff. It's very modestly inflationary. I mean, you're talking about 0.1 or 0.2%. But you hear the press, inflationary tariffs, inflationary tariffs. That's blown out of proportion. Now, if you put 25% tariffs on all imports, okay, that's a lot more. That could be, in my view, quite recessionary and inflationary.
On the point on interest rates, you brought up the 10-year. We have Treasury debt held by the public approaching 30 trillion. It's, forecast to grow to over 50 trillion in the next decade. Is that an issue that you see? I mean, are you confident investors can absorb that volume of treasuries without much higher interest rates?
I think it's a problem staring us in the face, and we're heading towards that cliff. I just don't know where that cliff is, a month away or 10 years away. And, if you look at our projected deficits, they're so big. The $2 trillion, the 7% of GDP is the largest peacetime ever. The 100% of GDP total debt is the largest since, other than a war. The world is doing this too, but it wasn't just us. And remember, all that spending also fueled inflation and growth. And what else did it fuel? Corporate profits. And you don't hear people talk about that much, so we can't do it forever. I don't know where in that curve when it's going to go straight line to like 115, 120% in 10 years, and then it's a hockey stick, mostly from demographics and Medicare and Medicaid. Unfortunately, I think we're not going to deal with it until it gets bad. And that's a terrible way to deal with the problem. It's better if we deal with it today. So maybe they will. I mean, a lot of people talk about it, but neither, in my view, I don't see either Democrats or Republicans saying, we have to handle this. It's mostly, people want to tax less and spend more, generally.
Are you and other primary
And I
dealers?
think inflation may not go away. That's the other thing about, I always say when you look at the world, that spending is inflationary. Okay, certain types of spending are less inflation than other types. Like if you were investing in infrastructure, that may be long-term, not inflationary. But we didn't. We gave the people $10 trillion and they spent it. And we're continuing to do that. And so, but look at the future stuff we have to do. The remilitarization of the world, that's inflationary. The restructuring of trade, at a minimum, is going to be inflationary. It really has, some's happened, but some hasn't. The green economy, we've wasted a tremendous amount of money. It's inflationary. The infrastructure stuff that needs to be done, it's inflationary. Deficits, I don't see the disinflationary stuff taking place. So that may be the thing that people get surprised about. That just doesn't go away. In fact, it ticks up, and people are expecting all soft landing. It may not happen. And we're in a soft landing, but it may not continue forever.
On that point, we have a lot of policy uncertainty right now with the new administration, with many things still up in the air. We would generally view that kind of uncertainty as likely to slow investment and cause, many to sort of step back and wait and see. Are you seeing signs of that from your perspective, the Business Roundtable, your corporate customers, and so forth?
The last stuff that came out, the CEOs and Business Roundtable, that CEO confidence is up. Consumer confidence is going down. That doesn't happen that often. I would submit the one I believe more is the consumer one. CEOs, they're not very good at predicting the future. They're pretty good at telling you how they feel and what their order book looks like. And they don't necessarily pick inflection points. If you're trying to guess an inflection point, you better be a little more thoughtful about those things that affect the inflection point. And so, yes, remember, there's always a level of noise. I mean, always. So that's like a cosmological constant. There's some things today which are good, pro-business, deregulation. There's some things today which are bad, which is tariffs, and we don't really know. You're going to find out, by the way, because in the next couple of months, they're either going to do something or not, and you're going to be more comfortable. You hear a lot of announcements about capital spending. Some are probably going to take place. So I don't know. I say, yes, things are weakening a little bit right now. That doesn't mean they're going to not strengthen down the road. I think what will cause the most lack of confidence, in my view, if we fail to fix Ukraine, with security for Ukraine, if we fail to set the Middle East on a proper path, if we fail to get some kind of tax deal, if we fail to get, if the tariffs get really bad, if some of this international relations with China gets bad, that's the stuff that you can, I think, could push you into recession. If it doesn't get done. If it gets done, that exuberance was justified.
So I want to open up to questions from the audience in a minute or two, so be prepared for that, folks. But before that, if you had to pick one big risk that sort of keeps you up at night right now, what is it that's...
It's geopolitics. I mean, I look at the economy as the weather. I don't worry about the economy. When it goes up or it goes down. I don't mean it bad. I don't really care. I think people waste so much words. What do you think? What's going to happen? And if you're trading stocks, maybe you have to do a little bit of that. But it's the geopolitics. I think we're at a crossroads, which is about the future of the free and democratic world. That, to me, is the only important thing. And that's how we handle Ukraine, Iran, Russia, China. Iran having a nuclear weapon, that'll change. That will be terrible. And America and or Israel will take severe action. Our relations with China, remember the other players in the world. They may do something to test us. Whether Russia's going to give in so quick and do something with Trump, I'm not so sure about that. They're committing sabotage in Europe. They're cutting cables under the ground. So I think that this situation is bad. American leadership is necessary, required. We have new American leadership who's doing it a different way. I wish them the best. Obviously causing consternation. Some of that consternation is not so bad. So I'm not, in favor of treating allies badly. But a little shock therapy is not bad. Europe's got to do a better job defending itself. And they have to do a better job fixing their economy. They've gone from 95% GDP of America to 65%. Okay, and that was political leadership. And it was because of regulations, labor inflexibility, the inability to finish the EU, the lack of a common market, the lack of a capital markets union, the lack of a banking union, and it's crippling their economy and their ability to take care of their citizens. And so those are the things that if we tear the world apart, I call it the economic battlefield, in trade, pricing, us against Europe, us against China, we're going to have an issue. So, America first is fine. America alone, if we end up alone because, we're tearing the world asunder, we will have made a mistake. I don't think that's the goal, by the way, but you have to be very careful when you start, like the IRA Act, some of you may not know this, when that act was done, Europe was so angry, and you know what? They should have been. It was done without any talking to them. It was basically America first and alone, and benefits us. They can't do the same stuff to keep up. They can't afford it. And it put them in a terrible position, our allies. And maybe it's going to benefit our jobs here a little bit. So we have to be a little more thoughtful in foreign economic policy, including development finance. We're very small. China's all over, Belt and Road. We need to make sure we keep our world safe and strong.
It's a great point. Let's open it up to questions from the audience. There are microphones going around. Please wait to receive a microphone before you go ahead and ask your question.
Hi, Jamie. My name is George. I'm actually a JPMorgan employee from the London Investment Bank office, so huge honor to have you. Actually, throughout my 10 years at JPMorgan, I've seen many cases of you being very personally effective and productive, including sending letters, going to meet with clients directly on an individual basis, which I found amazing for such a huge company. I was wondering if you could share with us any tips for how you keep up such productivity personally.
Yeah. Well, first I love what I do. That makes it. I take care of you should all take care of yourself, your mind, your body, your spirit, your soul, your friends, your family. So I try to do that. But I'm very conscious about how I spend my time, my office, what I do. And so whenever I go anywhere around the world, I do client lunches, client dinners. My chief of staff is here. We send out notes every week. So I'm in constant contact with folks. And my office is very functional, too. Who's coming in, why they're coming, what do they need. And half the time they don't need me. They want to know, they wanted that research report, or they want to know if they can have lunch with someone or something like that. So I think it's important. And I think it's important with whatever business you're in that CEOs get out. When they're I'm never harried, I'm never late, I've always done my pre-reads. I'm in my meeting, I do not have my phone, I do not get my notifications on my iPad. I'm looking at you, I'm focused, I'm learning from you. But whatever business you're in, when they tell me they're too busy to go on the road, to go out, they spend a lot of time with their board, they're making a mistake. Go to your call centers, go to your clients, sit in sales calls with your bankers and stuff like that, and you learn a lot. You learn a lot about the world, you learn a lot about your banker, you learn a lot about where we're falling short in a product or a service, because the client will tell you, Jamie, you wouldn't have won that thing, but HSBC's is better, or Stripe, integrated it better than you did, or something like that. So I think it's what you should be doing all the time. And you can structure your life that you have time to do that. And I do bus trips every year. I go to small cities, I go to small businesses, constantly learning, constantly assessing, constantly looking at the landscape, always being open to it, as opposed to what we did was right. I always tell people, my management means, I'm not interested in being right in the past. I'm interested in being right in the future. And I don't mind changing, because because a lot of the decisions we change are the ones I made. That's okay. If I give you a new job, I say, just make it better going forward. And don't pretend you don't need to protect me.
Hello. Thank you so much for being here. I'm really excited to speak to you because both my sister and wife are alumni of JPMorgan and love doing first-class things in the first-class way. I've admittedly listened to the leaked audio clip that was circulating on Twitter about your strong opinions about working from home or remote work. And I think many of us, as we think about the next steps in our career and thinking about going to places that are 5 days in person or remote work, or industries like investment banking where it's always been hybrid, 5 days in the office and 2 days at home. Would love to just hear some of your thoughts or guidance or advice on how we should think about these topics.
Yeah, so I've done thousands of town halls, and I answer every question honestly. The guy who asked that question said he was fired. I would never fire someone for asking a question, any question, whatever it is. I think they have the right, and if they're right about something, we'll change it. And I emote, obviously I should never curse. And I emote. I get up on stage and they say, "You what? You're going to do what?" I'm a human being. I'm like everybody else. But I was making he had said, "Why can't the manager decide?" And I was like, we tried that. And the managers, I believe in pushing power as far as down as you can. The regulators want it all centralized. I put as far to the branch manager, to the trader, with rules and constructs and stuff like that. And we tried that with this. But the fact is, they simply didn't exercise managerial skill. Everyone gave everyone everything, including people at my management table, by the way. And I eventually said, I've had it with that. And now, first of all, we have 10% of our people working home full time. We put virtual call centers in Baltimore and Detroit. We did it to see if they'd be effective. They're highly effective. They work from home. They're mostly minorities. That's why we did it. It's a home run. So I'm not against it where it works. There's 60% with full time is the other 30%. I also completely defend your right to say, I don't want to. But I don't defend your right to tell me what JPMorgan's going to do. So you have a free market. You can do one thing, I can do another. This one, that's what's called a free market. If you work in a restaurant, you got to be in. You all may not know this, but 60% of Americans worked the whole time. Where did you get your Amazon packages from? Your beef, your meat, your vodka. Where did you get the diapers from? Where do you got UPS and FedEx and manufacturers and agriculture and hospitals and cities and schools and nurses and sanitation and firemen and military. They all worked. It's only this people in the middle who complain a lot about it. I'm being quite serious. And you go to Washington, D.C. now, some of these people come in 5 days a month, and you're paying for it. So, but the other thing, here's why it doesn't work in our business. So it may very well work in certain things. The amount for the younger people being left behind, I've known this for a while. We can prove a little bit of it, and that is cumulative. It's not like the first month you're working. It's by the second year you have less people, you're put on less assignments, you know less what's going on, you have less conversations at the water cooler or in the cafeteria, so it's leaving them behind. I won't do that. And to have the younger people coming in but not their bosses, I have a problem with that too. And then people say to me always, well, it works for me. But actually, we were on a Zoom yesterday, and people were saying it works for me. And I said, yeah, but people are reading their mail and getting their notifications. And as I was talking, there were 12 people in the room and 4 people on the screen, and all 4 people on the screen were on their phone. And people say, and you think you're focusing and learning? And then as a management tool, when we meet in the morning, we talk, we have these debates all day long. We're talking, hey, no, I checked on that you're right about that. Here's what I think we should do. All day long. Constant update, constant share of information. So I tell you, it doesn't work in our business. And for culture, you talk about culture, it's impossible to do culture that way. And so, for us, we've made a decision. And that's why I explained it to them in a lot of detail and stuff like that, a little emoting in between and stuff like that. But and I explained DI. Like before anyone of you asked, we are going to reach out to the Black, Hispanic, gay, LGBT plus. We have jobs for disabled veterans. We reached out to the second chance initiative, like people who are ex-felons. We've hired 4,000 or 5,000. We're going to do all of that. We're going to modify, and this is where I don't know, but just take a deep breath. We're going to, obviously the law is the law. So we had to change a bunch of stuff, which I'm sure you guys had to. That's the law. It's not going to really change the outreach. It may change some names. We haven't decided yet we're going to change DI. I don't, me, it's a moniker. It doesn't mean anything. I'm not, my people hyperventilating over it, I'm not. I think this stuff is, and then there's stuff, while looking at this, but even before President Trump was there, we were looking at some of these programs. We overdid it too. We had these bias training programs, which were a complete waste of time. I mean, literally, let's call it what it is. It has nothing to do with reaching out to the black community. It was a waste of time. Then we had departments imposing, sending you compliance things, and then we had too many small efforts we were making. So we're consolidating that, but our effort to reach out is the same. It's 95% commercial. We've got, I think, 1,500 branches in LMI neighborhoods, lower middle income neighborhoods, and we're going to do fine. And if politicians come after us, they don't. Wherever I go, we're fine with the politicians too, by the way.
We have time for one more question.
Thank you so much, Jamie, for the time and the conversation. It's been really great to hear from you. My name is Hollis Rhodes, and I was just wondering if you could expand on a comment that you made a little bit earlier in the conversation about how the green economy has been a great waste of money. Could you just expand on that comment? That'd be great.
So climate, we have an issue with climate. So if you said to me, we should all have plans to get CO2 down, I agree with that. That's not what we did. We came up with a bunch of policies which were giving gifts to rich people, like all the friggin' Teslas you have with 7,500 gifts. That's not right. And that's not going to lower income people. It's not even really fixing the economy because a lot of the electricity in those machines comes from coal. So it's a lie to start with. But I just give you examples of the stuff we haven't done or could have done. And there's a pipeline that had been built like hundreds of miles, and the last 5 miles didn't get built, which would have brought gas into New York City. Because of the virtual signaling of climate and the anti-pipeline people, it didn't happen. So New York City is paying, I forgot the number, twice as much for electricity, and it's a lot dirtier because it's coal. That's all. Is that a rational decision? Same thing, we couldn't get permits to build, not us, but a wire taking hydroelectric power from Canada into Massachusetts. Because now on the other side, the green people fought that. Okay? Because of that, Massachusetts is paying 3 times as much as they have to for electricity, and it's a lot dirtier because it's coal and diesel oil. That's what we did. A lot of what we do, a lot of the CO2 we reduced in America, because it's down quite a bit, half of it wasn't that we reduced CO2. It's that we outsourced the dirty stuff to China. So when you move steel, rare earths, a whole bunch of stuff to another country, you didn't reduce your CO2. Okay? In fact, their standards are probably much lower than ours. But the company can say, I got my CO2 down because people are pressuring me. I can go chapter after verse after chapter after verse. We put in the IRA, the IRA Act to do some of this. 50% of the money, we think 50% of the money is wasted by virtual signaling about placement and unions. And so we're not going to fix it that way. And oil and gas can be around a long time. I think we are going to fix it. I think a lot of R&D is going to fix it. It might be carbon capture, it might be biomass, it might be fusion, it might be small nuclear reactors. Those things might actually work, but what we've been doing is not fixing the problem. Biden canceled these LNG, I visited the LNG sites in Louisiana, which was sending LNG to Europe. He canceled future projects. And I'm almost incredulous because it would have been great economically for the United States. I mean, you're talking about $100, $200 billion a year revenue. It would have been great for our allies. They need safe, affordable energy. If it's not affordable, Germany, Netherlands, Philippines, all turn back on their coal plants, which is dirty. So it had the virtue of being clean. It had the virtue of being geopolitically good. It had the virtue of being economically good, and we simply turned it off. So now those allies are saying, there's one more thing they're saying about keeping the world together, about saying, can we trust America? Can we trust you? Will you be there when we need you? Are we going to have every time a president comes in, it gets canceled, it gets turned on? So we've made mistake after mistake. And you guys, the next generation, you always have to ask these questions. Don't get into the ideology of, climate, this. That's not going to solve it. Michael Semlis, if you want, has a great report that goes through all of this. We can't build a grid. We're not building grids. We're not hooking people to grids. And I can go on and on and on. So I'm highly frustrated with American policy, domestic policy on immigration, taxation, regulation, healthcare, education. Like schools should be measured on what's the outcome, not the teachers. Did they get a job? You can make $65,000 a year as a 17-year-old as a teller, cyber, data. Well, every high school should be doing it. Every high school should be teaching financial education. Everyone. What's a checking account? What's a rainy day fund? Everyone should be teaching wellness, like just nutrition and wellness, and teach their parents. We don't do any of it. And if we did that, we'd have a far healthier country. And for those who want to help the lower income, all these things will help the lower income more than the higher income, all of them. And so, I hope when you get into, and I love this effort you guys are making, which you call again business, government,
and society.
So JP, and I know there's a long answer. So we, uniquely among a lot of companies, have literally advancing cities. We're teaching cities about education and financial education and community branches, and we have people who teach the world about climate. We have deep sciences about climate, what that company could be doing. We teach countries how to manage their own balance sheets. We finance the MDIs and minority depository institutions. We advise our clients in cyber, AI, geopolitics. So JPMorgan plays this huge role with government, and we're going to send you a bunch of stuff that we do. So as you build it out, you see that, and that's not true, by the way, for a lot of companies like down the street here. They could care less about that crap.
Well, thank you, Jamie. I know many folks have to get to class, but thank you so much for this.
Thank you. Appreciate it. Thank you for having me here. Thank you.